Alright, welcome back. So this one is on the US dollar and emerging markets. So to set the scene, emerging markets have made a strong start to 2026. Stocks, bonds, and currencies are all up sharply. In some cases 10 to 20% in dollar terms in just 1 month. The key point here is, why this is happening. It's not because emerging markets suddenly became fashionable or risky appetite exploded. It's because the US dollar has fallen to a 4-year low. So when the dollar weakens, global capital naturally looks for returns outside the US, and emerging markets are one of the main places that money flows. So why does the dollar matter so much? Well, because it sits at the center of how emerging markets work. Many emerging economies borrow in dollars, sell commodities priced in dollars, and rely on investors who measure returns in dollars. So when the dollar falls, three things happen almost mechanically. Debt becomes easier to service, commodity revenues rise in local currency terms, and returns look more attractive to global investors. That's why emerging market performance has been inversely related to the dollar for decades. This rally isn't unusual, it's a normal reaction to a weaker dollar. What makes this cycle different is that emerging markets did the hard work years ago. Central banks across emerging economies raised interest rates well above inflation, defended their currencies, and accepted slower growth while the US was hiking aggressively. At this time, this went largely unnoticed, but now that the dollar has turned, those decisions are paying off. Investors trust these central banks more, and high interest rates combined with stable inflation make emerging markets genuinely attractive rather than speculative. The rally isn't random. The strongest performers share common drivers. In Asia, chipmakers in Taiwan and Korea are benefiting directly from AI demand, with memory chip prices rising almost fourfold since October. In commodity-linked markets like South Africa and parts of Latin America, higher prices for gold, silver, and industrial metals feed straight into company earnings and currencies. And beyond that, many emerging market companies, especially in fintech and e-commerce, are market leaders that compete globally, not just locally. So this is earnings driven, not hype driven. A lot of the story is actually happening in bond markets rather than equities. Emerging market local currency bonds are outperforming US high yield debt, and many of those gains are coming from currency strength, not just interest income. Investors aren't panicking out of the dollar, they're diversifying away from it, and local currency emerging market debt offers high yields plus potential currency upside. This is a very large market, around $25 trillion, but global ownership was low for years. Even small allocation shifts can have a big impact. The main risk people point to is a stronger yen, which could unwind carry trades and hurt emerging markets. What's different this time is that the flows aren't just short-term hedge fund trades. There's real money buying emerging market bonds and equities, and that shows up in balance of payments data. In the base case, if the dollar continues to drift lower, emerging markets remain supported. In a bull case, further dollar weakness leads to a broader re-rating. In a bear case, a sharp dollar rebound would slow the rally, but not necessarily reverse it. Overall, this looks less like a short-term trade and more like a structural reallocation. So that's it for the video. Again, if you guys enjoyed it, then please subscribe and like, and I'll see you in the next one.